My name is Philip Piper. I'm a co-founder and council member of Swarm Fund, and council member because we're a nonprofit organization, which is I'll explain in a second why that's an important feature. The reason I'm here today is actually threefold. One is actually I've been here 20-something years ago when I was actually doing portfolio management for Allianz Group in Eastern Europe and Asia Pacific. So I spent some time here helping build the Allianz Group actually that is also operating in Serbia. Second of all, Ivan and us have developed a fantastic partnership. We have an extended team here that actually is locally here in Belgrade. Exceptionally talented people. I have experienced like a slew of different other areas where I did sort of partnerships, technology development partnerships, and it's a very unique partnership that we've been able to develop in 6 months' time. And the third thing is that I truly believe that Serbia, when listening closely to what I'm going to have to say, can actually have a really, really big role to play if recognizing actually what needs to happen from a financial markets ecosystem. So the opportunities that lie today in the financial markets and creating new paradigms are immense. And we're seeing this happening at light speed, although it might not be that obvious to everyone in the market. Big institutions are tap dancing. They're not actually waiting until things are happening. They're actually changing the infrastructure. So what I'm going to talk today about is actually Swarm Fund. It's a project that actually was initiated before my time in 2013. It tried to build a governance system on top of the Bitcoin blockchain, which was a horrible technical experience, and the market obviously was very much smaller than it is today. And then sort of I moved next door to the founder, and then we reinitiated this project out of Silicon Valley, and I moved actually to Berlin to actually last year to extend it. So what I'm going to talk about today is, and I'm hoping not to repeat some of the stuff that we've heard, but I think it's very important to actually take a step back and really embrace what it means in terms of the efficiency gains that we're trying to bring to capital markets. So capital formation obviously has taken a really interesting path. So it comes actually sort of from proper capital markets, and actually crowdfunding was the most innovative part of our capital markets in the last couple of years. We're not in the US only, but actually in Austria, as we heard, and other places. There was a big notion of actually what it means to involve the broader swath of potentially interested investors in capital markets, and basically extend the reach of what these assets could actually sort of reach. Then we saw the dawn of cryptocurrencies, very slow 2008 onward, but actually hitting it at full speed in 2016 and 17. Now, I'm not here to sell you on the promise of actually sort of, government-less currencies and what the use of that is, but it actually did revolutionize a lot of the notion of, what are middlemen and are they really necessary in some of these concepts? And the magnitude obviously made people really wake up and say, what is happening here right now? And most of the drivers of that influence was driven by digital natives. And we're talking about a big group of millennials globally that don't operate locally, that actually think in terms of digitization. And for the first time in history, we had actually a fully digitally native currency that wasn't controlled by traditional institutions, which led to a interesting development of ICOs, which was in 2016, starting in 2016, extending in 2017. It still is around, but actually, obviously, it was the Wild West. Let's put it this way: it was a crazy time when people started to discover what it meant to have a global exposure of assets and what that can do. Now, not everything was pretty in that market. It was obviously littered with a lot of fraud, littered with a lot of unknown and unsophisticated investors, a lot of people that played the market, a lot of people that were not there for the right reasons. And that obviously then sort of with the attention that it gave to regulators, rightly so, actually went down into something that we saw previously actually as sort of a lower market segment, which then people assume when we talk about STOs, or actually the better term for that is digital securities, because what we're talking about in the digital security space is that anything that is a security, so something of value, something of an asset, something of a debt position, some an equity position, a commodity, it can be wrapped with a digital wrapper. And that digital wrapper, I'll tell you in a second, is actually sort of a powerful thing because it allows a tremendous amount of flexibility for those who want to operate with that digital wrapper. But I think it's worthwhile pointing out that the STO space is not just the extension of the ICO market in a regulatory fashion. Actually, what we're talking about here in the STO space is much, much bigger, and it actually impacts the entire range of capital markets, so much to say that a lot of people claim that within 10 years' time, every security will be traded on a blockchain-supported infrastructure. And that obviously, bearing in mind that we're talking about trillions and trillions of dollars, is a big statement. We'll see how fast that happens, but obviously we have a good number of signs to say that this is happening faster than we assume it is. The last one is what I call purple securities. So we're not talking about black and white. We're not talking about whether this is a security or a utility. But here we're talking about the advent of financial systems or financial products that actually have the mix of both, and maybe even something special beyond that. And a good explanation of that is that sometimes you want your shareholders to experience operationally something with your product, and the interplay of that and having people participate materially in the underlying equity, but also, you know, have a product experience is very powerful. So think of it that you possibly could have a ski resort that actually doesn't lend from capital markets, but actually the skiers that go there every year are sort of doing this as a cooperative. And by doing it as a cooperative, for the time that they hold a security, they possibly get passes to skip the line. That couldn't be done previously. That is not something that so far could have been achieved because there is a clear separation between a product and what it does and the capital. Enough with how capital markets function. But in fact, my argument is, I think we can be more compliant with today's regulation if we use the blockchain, because there's a higher degree of auditability, transparency, and a higher control who gets to trade what. And that leads to all sorts of interactions with the investors. I mean, all these arguments are somewhat implicitly also applicable to the investors. But in the end, the higher degree of price appreciation is something that really is tangibly valuable. There can be models that blend equity positions with revenue participation or debt participations. We've seen this from a bit bond. And then there's an ongoing dividend opportunity. So you don't necessarily have to wait if you have, for example, a bond. You don't have to wait for quarterly or annual distributions. You can do this on an ongoing basis. You could do this every second. And that obviously is, that's time and money that actually can be valued back into the price. So talking structurally about the market, and I hope not to bore you with this, but I think it's worthwhile pointing out who are the actors in the capital markets today. So you see from the issuer side, basically the issuer going to a public capital market says, okay, I'm going to issue a share register. I'm going to sort of do my prospectus. I'm going to go to a clearing house that actually holds my paper asset, and that gets digitized. And the actors on this marketplace are brokers. Meaning that the bank and the broker often are the same entity. You have a controlled number of actors on this marketplace, and the seller, we as sellers, we as investors, actually interact with the bank. And we don't really recognize that actually everything in the we assume when we buy Apple stock that it's immediate, that it's really right there. But in fact, this system, as it stands today, actually takes 3 days to settle something of a transaction that we've done today or right now until it's actually sort of settled and transferred in terms of value. Now, at a daily trading volume of $340 billion, that's a lot of money. Times 3 days, that's a lot of money of inefficiency. So we can put some real numbers against this. Now, the problem is also compliance, and we saw this actually after 9/11, that suddenly there was an American, an American desire to actually have compliance be deeply rooted into every aspect for the right reasons, right? So the so-called SOX compliance, other capital markets compliance. So every single actor here is actually separately licensed, is separately followed as a sort of, as an actor, and there's hordes of different, actors on the regulatory side that have to be staying on top of actually every action in this market. Well, this is the chance, this is the opportunity, because you can actually think of, a system, and I'll show you that in a second, that actually gets rid of all these actors. So when you say get rid of intermediaries, we can get rid of the bank actors, we can get rid of the brokers, we can actually get rid of the share registries that are connected with a central clearinghouse, and in fact, it will actually look much simpler with a much simpler compliance. And this is when regulators wake up. This is when regulators actually say, wait a minute, you're telling me that this system is superior to the one that actually we're comfortable operating today? And when you really dig into the proof points, meaning sort of what can they actually see, what can they actually tangibly see in terms of data and control, it's provable. And I would even argue, and I wasn't in this position actually six to 9 months ago, I would even argue that we can get rid of the clearinghouses. And we've now successfully already convinced 2 regulators in Europe to not use clearinghouses because they were convinced that the transparency and control is of higher degree than actually working with clearinghouses. And that obviously is going to really liberate a lot of models. And we're not talking about like startup funding, which I think could benefit from it too, but we're talking about big asset classes, from big bonds to IPOs to even illiquid asset classes that so far had no chance to go to a market. So pre-IPO tech stock or smaller companies that don't have a IPO story. So what do? Well, we try to hide that complexity from the actors. Our goal as a nonprofit is to give technology infrastructure to the issuers, to make them navigate this space without having to really concern about the technical ins and outs of how smart contracts work. We are even hiding the term of wallets. Why should an investor actually know what a wallet is? It doesn't make sense to them because they have not been operating on this. So we actually bring open access and liquidity to private capital markets. That's the first step because it's the one that has the biggest challenge. There is no market for these assets at that point in time when we actually tokenize them. So, and I'm not going to go into every detail. So what we do is 3 things. One is actually and this is all open infrastructure. So we're just in the process to open this up to anyone who wants to use it, and we'll talk about that in a second. So token issuance is the process of actually configuring anything from a token infrastructure. The second thing is actually programmatic compliance. So we built an open ecosystem that actually connects the token issuers with qualification providers and becomes a reference graph for exchanges. And then the third thing is actually something that people tend to forget, that there is a life after the token is created, and it involves governance. It involves verifiable reporting structures, et cetera, et cetera. So we actually I'm not going to go into the structure, but very simply said, assets are held in so-called SPVs, which are legal entities, and then they're actually traded on this controlled marketplace with controlled actors, which are known, which are AML and KYC to whoever knows that term, and that are fully transparent to the issuer to report back to the regulator. And it's not just saying whether someone is able to hold a security, yes or no, and that's a complex picture right here because you need to actually find out the nuances, saying is this a hot dog that looks good, or is it really a hot dog by the term of it? And this is the same thing that has to happen on the investor side, but it actually goes more into a lot of complexity that actually has to be replicated that is known from the capital markets. So a wallet A transferring to wallet B needs not just the investor qualifications, but it needs possibly other transfer restrictions. Sometimes there is a so-called right of first refusal, which, where the company has a say whether there's a transfer that should happen, et cetera, et cetera. We're hiding all this into a language that is operating on a distributed infrastructure and that is endorsed by regulators. We tokenized 11 funds. We have a distributed infrastructure of now 350 actually master nodes. We were surprised to see that there was 40,000 investors coming to this, coming from 89 countries, and we saw similar numbers actually recently. This is the global nature of it. I mean, we didn't choose to go into 89 countries, but actually they came to us. And this was the most surprising thing. If I would have bet my career on actually what would be the most difficult thing, it would have been probably convincing issuers that this is a bet to take. Well, we have 85 projects that want to tokenize at this point in time, coming from real estate, from pre-IPO tech companies, there's sports teams, there's impact investing, there's gaming companies, all sorts of companies that have all different angles of what they want to do here. So this is the last slide. We announced actually early this year that actually we're doing this for free, meaning that these tools are freely available for anyone to use. So far, we've been controlling the releases just to test the product, but actually within the next weeks, we're actually just going to have an infrastructure that anyone can turn to, which I'm glad to show to anyone who's interested. It's blockchain agnostic. So even here we're high complexity, which normally we would require the token issuer to know something about technology and say whether Ethereum is the right one or not the right infrastructure. Well, here we are saying this is actually infrastructure that connects different technology infrastructures. All we know is it's going to be a blockchain-based system that is going to be the future of capital markets, and we're going to be compliant with it. The last thing is actually the market access protocol is an open infrastructure for any of the industry actors to come and participate. And we have 10 different companies, service companies from the qualification side that are already connecting to this. These are market standards, market standing companies such as Jumio and LexisNexis and others. So even those guys are embracing it, not just because they see the value of the future market, but they also know that they can have a participation in a new business model of some kind. And just last week, actually last Wednesday, on this new version of the platform, we launched 2 funds. One is Resolute, which is a real estate fund, and the other one is Index, which is a so-called masternode fund. But wait for the next couple of weeks because we'll have a slew of other projects that are coming here. And I truly think that this infrastructure and its likes can actually help a market, a capital market like Serbia, which is not really connected with the traditional capital markets, leapfrog ahead and actually create legislation that can actually make this a much more attractive marketplace. Reach out to me. Thank you so much. And